And to break down these results, we have Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Thomas, thanks for your time today. So let's start with Microsoft, because the initial concern was that there was a slowdown when it came to data center leases, but that's not what we saw. We're seeing increased spending, in fact, increased demand for its cloud division. Does this put concerns of overspending, overinvestment, and even slowing AI demand behind us?
Well, they absolutely crushed earnings, Sarah. And to your point, they raised revenue guidance by $1.25 billion. They're expecting Azure growth, the cloud growth of 34 to 35% after hitting 33% this quarter. So all the concerns and all the rumors about leases being canceled, et cetera, were in vain. Revenues were up 13% versus 8% expectations. Earnings were up 18% versus 10% expectations, and guidance was strong. So this is in line with what we're seeing so far in earnings season, which is earnings are up 10.1%. And that's why when we saw the Atlanta GDP now had been predicting negative 2.7% GDP, we thought it was a little bit ridiculous. I mean, GDP did come in at negative 0.3%, but as you referenced, Sarah, that was mostly due to inventory building ahead of tariffs. X that inventory building, we would have had positive GDP growth of about 3%.
Yeah, we'll get to the GDP more in a bit, but I want to get to Meta as well, because they posted strong advertising revenue, and that's despite concerns over tariffs and what these tariffs can do when it comes to corporate spending. What does that earnings results tell us about the potential drag that tariff uncertainty and volatility would have in the corporate sector?
Yeah, well, the ad revenue was the big question mark. People were a little worried about consumer sentiment, et cetera. Came in $41.3 billion of revenue versus $40.4 billion estimated. Unlike Microsoft, which raised revenue guidance, Meta's guidance was in line with expectations. And some of that is due to the fact that 10% of their ad revenue comes from Chinese sellers in the US, and that's probably going to go away a little bit in the second quarter. So they had to take that guidance down. But overall, very solid on the daily active users, 3.43 billion versus 3.39 billion estimates. So all in all, I mean, earnings 6.43 versus $5.24 estimate, revenues 42.3 billion versus 41.4. Really, really good, and alleviated a lot of fears in the market. And I think you're going to see some follow through with this positivity after market.
Yeah, and we briefly talked about GDP. They're shrinking for the first quarter, and there are now concerns about stagflation, of course. President Trump blaming it on his predecessor. Some analysts are attributing this to front loading. But what do you think about the numbers, and what does this tell us about the path ahead for the U.S. economy?
Well, I think the negative is a positive in the sense that it brings in three puts on the market. Number one, you have the Trump put. On April 8th, he said, now's the time to buy the market. That was the bottom of the market that day. Today, he came out and said, be patient. America will boom. So, Trump is now watching the markets. Then you have these three numbers that were weak today. The GDP was weak. The ADP job numbers, 62K versus 120K, was weak. And inflation came in the lowest since November, the PCE prices at 2.3%. So those three things bring back in the Fed put, and we're now pricing in about a 65% chance of a cut in June. And then the final put was the Treasury came out with an announcement that they're looking to enhance their Treasury buyback program to lower long-term lending costs, i.e., bring down the yield on the long end of the Treasury curve. And that is very, very constructive for the economy. So what's bad is good. Our earnings have been very, very solid. Guidance has been pretty good. These economic numbers bring the Fed back into play. And the most important thing will be the jobs report on Friday to see how that labor market is doing and how quickly the Fed is going to step in.
Yeah, so now it sounds like you are waiting for more support from the Fed and the Treasury. Thomas, will that be enough, though, to carry the U.S. markets higher forward, even with this backdrop of uncertainty and volatility? How much room do you think Wall Street can go higher from here?
Okay, so what we had on April 8th and April 9th was record selling at the lowest point when the market was down 19% by hedge funds and CTAs. What's basically happened is we've had this rebound, about halfway rebound. They are praying for a retest of those lows, and praying rarely works when it comes to investing. So as the market pushes higher, maybe it's going to be more earnings, but I think it's going to be deal announcements, trade deal announcements. All of these people that got short at the exact wrong time are going to be forced buyers in coming weeks as we get deal announcements. And that's going to probably be the surprise of coming weeks, is that while everyone's skeptical and some of the economic numbers are slowing a bit, is that you have forced buyers who basically sold at the exact wrong time that are going to have to get in and chase once we get some positive news across the tape as it relates to trade deals.
Yeah, and we'll watch that closely when it happens. Thomas, appreciate you. Now this is Today. Thomas Hayes there, Chairman and Managing Member at Great Hill Capital.